Hi everybody, welcome to the show. This is the Objective Financial Hour. My name is Jason Heath, and with me today is my partner Paul McVean. I've known Paul for a long time. He's now a new member of the Objective Financial Partners team, and wanted to spend a little bit of time today talking about the types of things that he has done in the past and the types of things that he could and we could be doing in the future. It's kind of a new take on the provision of financial advice and financial planning within the industry, and rather than chirping away too much, I'm going to pass things over to Paul. First off, Paul, wanted to welcome you to the Objective Financial Hour and to the Objective Financial Partners team.
Thanks, Jason.
Wanted to talk a little bit about you. You've got a fairly diverse past in terms of your experience within the industry that's got you to where you are today.
Yeah, absolutely. I come from a tax accounting background as well. I've been involved on the financial planning side in the past decade or so. I originally trained as a tax accountant for one of the big four accounting firms. Got a lot of experience working with owner managers, particularly both on the compliance and planning side. And at the time, the firm I was with one of the partners wanted to build out a financial planning division within an accounting firm.
And is that common within the accounting industry?
Really not very common at all. There have been some other firms that have gone into the wealth management space looking to invest client dollars. And
so accounting firms that have looked to also provide investment services?
Exactly. Okay. And to my knowledge, those situations really don't exist much anymore. I'm aware of one smaller firm that is offering something like that, but the larger firms that have gone down that road have really backed away. With the accounting firms, what it seemed to be was a lot of them couldn't find a way to bill for the time that was involved in doing the financial planning, and there was a perceived conflict of interest where somebody was giving advice and investing the dollars at the same time. So when the firm I was with was not able to launch a financial planning division within the tax group, I decided to move on and get into the fee-only financial planning world, which I thought was a great fit for somebody like me who had a tax planning background, who wanted to be in a position to offer advice, but didn't necessarily want to be tied on the product side.
Now, one thing that I find is in explaining to people what fee-only financial planning is, I often compare it to the hiring the services of an accountant or a lawyer. I find they're kind of similar, and it's a lot easier to understand what fee-only financial planning is. People hear financial planning, they think, oh yeah, investments, insurance, all that. It's all free, you get paid by the company, whatever the case may be. Fee-only is a little bit more like the accounting or the legal industry.
Absolutely. I think financial planning, to me, it's a professional service that is offered to clients, and just like services like legal services, accounting services, fees are paid for expertise that is provided for work that is done, rather than working on a commission basis where the revenue model is based on the provision of a product. And with financial planning, I think one of the issues the industry has had over the years is the terminology. There is no rhyme or reason for who can call themselves a financial planner versus a financial advisor versus an investment advisor, a stockbroker, any number of categories. So it's a direction I'd like to see the industry move, and I think there is some movement that way, but unfortunately the term financial planner is not a protected term. So there is a lot of confusion in the industry about what does financial planning actually mean. And to me, what it means is providing expertise around a person's financial affairs. In my own experience, I've worked a lot with people who own businesses, owner managers, and they have a number of different complexities that non-business owners don't have, particularly involving their ways of being compensated, the fact that they may own investments inside their corporation, their investment holdco, and calculating how things will look for them in the future gets that much more complex because there's so many additional variables involved. So for people, particularly those who I've worked with in the past, owner managers, the provision of financial planning requires a particular expertise that isn't necessarily tied to providing products at all. And that is an area that I've worked in for about the past decade or so. For the last 8 years or thereabouts, I've worked for one of Canada's largest wealth management firms, assisting financial advisors in providing expertise to their clients.
So now that's an interesting point, because I often find people kind of assume that their investment advisors should have the financial wherewithal to be able to help them with all things financial, or their accountant for that matter. I find a lot of people think to go to their accountant for, investment advice, and likewise to their investment advisor for tax advice.
Yeah, I was just going to jump in and say the same thing on the accounting side as well, that just because you deal with numbers does not make you an expert in all things numeric. Financial advisors have to go through a certain amount of training to be able to provide product, to be able to be licensed to do that. Accountants have to have experience in order to get their designations, whether CAs, CGAs, or CMAs. But there's no particular requirement to have a significant amount of tax planning expertise or financial planning expertise for any of those people involved. Designations tell you that advisors, whether on the accounting side or financial side, may have some level of experience in terms of receiving those designations, have some level of education, but it's not a sign that they are necessarily specialists in any of those areas. So really, when it comes to the provision of professional financial planning advice, you have to look at what people have done in terms of their experience. Where have they actually gained professional knowledge over and above having designations or other qualifications along those lines? So accountants don't necessarily do a lot of tax planning to get qualified and may never practice in that area. Financial advisors may have some background in tax, may have some practical knowledge working with clients over the years, but wouldn't necessarily be experts in those areas. Okay. Some are, but many are not, yet clients look to them for answers in all things financial. So one of the things that I really enjoyed in that role was I was able to come in and provide a particular amount of expertise in the tax planning and estate planning areas for owner managers specifically, where advisors, financial advisors, tend to have to know a broad range of topics. They can't get into them as deeply as somebody who has a very narrow range but has the opportunity to work in that one area specifically. So in my role, my job was to know tax planning for owner managers to the nth degree, and when advisors had complicated situations, they were able to bring me in, and that way I could apply my expertise as part of a well-rounded approach to looking after the clients.
So then, you were working within this wealth management firm. You didn't have clients that you were managing wealth for directly. Your clients were more the advisors themselves.
Correct.
The advisors themselves were looking to you for your expertise to provide to their clients.
That's right. I was part of a team that advisors could call upon to bring into client meetings to assist, but it wasn't my job to have clients directly. Okay. So the advisors themselves would have the clients, and then we would be able to come in and talk to the clients and help them with their more complex problems.
Okay, and is that a more common approach these days within the wealth management industry, that companies are having internal experts like you were at that firm?
We are seeing more financial firms build out expertise, but typically the expertise is attached to product of some sort, because that's where the margins happen to be in the wealth management world.
And when you say attached to product, what do you mean by that exactly?
Well, clients would have to have a certain dollar amount invested, generally in specific product lines, to then be able to tap into the expertise that firms might have. Within the wealth management community, there are, I guess, a growing number of accountants and lawyers and other financial planning professionals who are working for basically the head office of these firms to support advisors. So we know that that model is gaining popularity, but it still can be fairly restrictive as to who gets access to that expertise and how much access they may have.
And when you say who's getting access to it, not only the client who has to have the money invested in a certain product and a certain amount of money in a lot of cases, but also the advisors themselves.
That's right. The more money advisors have in solutions that are attached to head office, the more likely they would be able to tap into that expertise. Likewise, the more dollars the clients have invested, the more opportunity they would have to bring those resources in. In some cases, we are seeing thresholds of anywhere from a minimum of $5 million to $20 million before that expertise can be brought in. It's not necessarily like that across the board everywhere, but we know it is not necessarily widely available to the general population.
That's a shame. You know, it's I guess from a business perspective, I can understand why companies would do it that way, but it makes it tricky both for the clients and for the advisors as well.
Well, what we find too when we look at particularly business owners is they have complexities no matter how much money they have, just like non-business owners as well. So just because you have a lot of money doesn't mean you have a lot of complexity. It tends to work that way, but in many other cases, business owners may have significant complexity before they've accumulated much wealth and may not have the portfolio size to be able to tap into the resources that may exist in the industry today.
So they may have a very valuable business on paper, but that doesn't mean they've got money to invest with an investment advisor to meet a certain threshold and get a certain level of advice.
Absolutely. Within the wealth management world, the key words that people like to hear are liquidity event. They like to understand, they like to know when dollars will be available to invest. And that may or may not tie into the need for expertise.
So then somebody who does not have enough money to invest and meet these thresholds to gain access to this advice at a wealth management firm, or somebody who maybe simply does not want to invest in a particular product or a certain amount of money in a particular product, where do they go for this type of expertise? I gather if you're talking about internal financial planners, lawyers, accountants, you know, outside in the non-wealth management world, those people are all kind of separate and doing their own thing. I mean, you have to have 3 different advisors helping to build a plan for you?
Well, that's generally how it works these days. We see that professionals often operate in silos. So if you are an individual, or you're a business owner, non-business owner, if you need to get tax advice, you might go to your accountant. If you need to get estate planning advice, you might need to get new wills prepared, you would go to your lawyer. If you think you might need insurance, you talk to your insurance advisor. And really what happens is the client ends up spending the time bouncing from one professional to another, getting advice on all fronts that may not ultimately be very congruent. It may not be coordinated, and one professional may not know what's happening in other areas of the client's lives. So one of the things that we find most valuable that we can provide is to be that financial quarterback and make sure that all of those moving parts are working in order. So outside of the client having to build all of that themselves, there are a few firms like ours that provide financial planning advice for a fee. And one of the things that I'm excited to bring to the table for our firm is the ability to provide our financial planning service through financial advisors to their clients so that they can bring that expertise to bear, regardless of the asset size, regardless of the investment solutions that they decide to use for their clients.
So just to sum up, I guess, in your new role, you're in a position where you are able to be hired directly by a client who is looking for comprehensive financial, tax, and estate planning advice related to their their company and related to their personal finances, but you're also in a position where you're providing those services directly to investment advisors.
Absolutely. We're really running two different lines of business from our own firm's perspective. Mm-hmm. One, we certainly have the ability to work directly with clients. They can tap into our resources without involvement from any of their other professionals, investment advisors. We certainly would be happy to work with those other people that they have and help coordinate the advice, but they can come to us directly. But the second thing that we find particularly unique in this industry is our ability to work with financial advisors, given that we have a lot of experience in providing expertise with financial advisors to their clients. We are able to package our services together in a way that makes sense for financial advisors to want to bring us in, to have us involved in providing that expertise to their clients, and really giving them a better opportunity to provide holistic, thorough, comprehensive financial planning.
And you are neither investment nor insurance licensed, so you don't sell any products, nor are you able to sell any products.
That's correct. I guess you could say I'm product agnostic. I don't really mind what products, or I shouldn't even say what I don't mind, but it's really not my expertise to tell the advisors what products they should be using for their clients, other than we can provide some oversight to the client. We can give them a second opinion, a second set of eyes to look at things and say, yes, this makes sense, or no, you may want to consider alternatives. Mm-hmm. So we can help clients understand if they are doing things that are good for them, but it's not our expertise to step in and be the investment experts or the insurance product experts.
That's great. Okay, well, thanks, Paul. We're going to take a break now, and when we come back, we're going to talk a little bit more about this interesting concept and the different ways in which somebody can secure the services of somebody like Paul.
Find it only in Jews and Palestinians.
A very good job at keeping it under control.
That liberating people who are thought to be unjust because of social, economic, or political conditions.
That time I thought it was so scary.
Officials,
everything you do.
When you know it, so you proxies of the Vision 27
meeting together.
As they began wrong things in the slow.
Hello and welcome to Mensch Life. I'm David Grossman.
Welcome everybody to the Anna Adi Show.
Welcome to Passion Point. My name is Irene Becker.
Hi, I'm Sari Colt and welcome to Chew on This.
Hi, I'm Gila Marto and welcome to Gila and Guests. Welcome to Ladies with Wisdom.
Welcome to Sketch It Up.
I'm Susan Radoshevek and this is Corner Office.
I'm Doris Epstein and remember to be a mensch.
Sometimes I hate being Batman.
You just admitted being Batman. You just admitted it.
No, guys. I said I hated being a fat man.
No, that was
being a fat man.
It was a hard beat. It was a hard beat.
That was all Bat.
Forget it.
Sure. Yeah.
Alfred, it happened again.
Dr. French.
Animated by one supreme being, which is the God.
We don't do this in a sense of feminism, rather this is...
The interesting thing is that the political will seems to have come.
You can find it only in Jews and Palestinians.
A very good job at keeping it.
Hi everybody, welcome back to the Objective Financial Hour. I'm Jason Heath, your host. I'm here with Paul McVeen. We've been talking a little bit about financial planning for business owners. We've talked a little bit, just touched on the provision of these types of services directly to clients, a little bit about Paul's background providing these services to investment advisors for their clients. And I wanted to get into that a little bit more. I don't think it's a very common business model here, really anywhere in the world, but certainly in Canada, for an accountant who is also a financial planner to provide financial, tax, and estate planning expertise directly to investment advisors. I'm familiar with other types of outsourced services within the US and the UK and Australia, all financial markets that tend to be a lot more further ahead as compared to ours. But I don't think there's a lot of people out there that are providing financial planning and tax and estate planning for business owners directly to investment advisors. Is that fair to say?
Yeah, to my knowledge, we are certainly unique in the industry in looking to provide services that way. I'm aware of another firm out west that is providing very sophisticated financial plans, somewhat through business owners, but really I think what we're doing that's a fair bit different is providing a whole range of financial planning services, going from a very basic number crunching exercise like a retirement projection right through to very comprehensive financial planning where we're looking at all aspects of a client's financial life. So I think it's certainly fair to say we're unique in the industry in the breadth of financial planning services that we're looking to provide. And I think we're unique in the fee-only world as well, having had so much experience working with advisors in the past to deliver services in a very seamless fashion.
Now, just to differentiate, you sort of gave two different extremes there. One, a retirement calculation, and one going through every piece of a business owner's financial life. A retirement projection would be what? How much do you need to retire? Have you got enough money built up that if you sell your business you can ride off into the sunset and be okay? That's the sort of...
Absolutely. It's really a simple calculation of saying how much do you have in the way of assets today versus debts? How much income do you have coming in versus money going out, your expenses? And then applying a projected rate of return to that scenario, letting it run its course for as many years as you need to, projecting expenses in retirement and rates of return and things like that, to come up with I guess, first and foremost, a sufficiency test, letting clients know if they've got enough money to last them based on the set of assumptions that we start with. And in some cases we can be a little bit more elaborate and look to put some parameters around their situation and answer questions like how much can I afford to be spending? How many years do I need to work before I retire with a certain level of lifestyle? So it could be a very simple number crunching exercise to say here's how much we're projecting you'll have left at age 90 or whatever year we want to go out to. Or we could look to be a little bit more descriptive in what answers we are providing. So I'd say a retirement projection could take a couple different forms, but essentially it's an exercise of projecting the current situation into the future and looking at the potential outcome.
Okay, so I'm a business owner, so you got to sell me on this. I understand the importance of determining how much is enough. What's your magic number that you need to have by age 62 and a half in order to retire? Beyond that, why dig deeper? What more can somebody like you do to justify the added work and the added cost?
Well, I think in simple terms, what we look to do is to identify opportunities and look to have clients avoid potential pitfalls. So if we look at an existing situation, we might do that number crunching exercise and say, you've got enough money. Does that mean they are taking advantage of every opportunity that is out there? Does that mean they are safe from all risks? With business owners, we have additional complexity, even in the simple retirement calculations, looking at how much income they're going to bring in each year. A salaried employee has a pretty good idea of what their annual income will look like going forward. We can always index things for inflation and have a good guess at how their situation might unfold. But we get into a number of additional complexities for business owners. Is the business going to always have good years? Will there be bad years mixed in? What form will the compensation take? So some of the modeling that we can do for business owners would account for some of those variables. But more importantly, when we look at the more comprehensive financial planning, we can really look to optimize clients' financial lives. We can look at what would happen if things go wrong, if they become deceased unexpectedly, if they're disabled, what if they have a business partner where the same thing happens, what does that mean for the business, what does that mean for the families involved. And we can look to save tax by using different strategies, whether it's looking at corporate structuring, whether it's looking at ways business owners pay themselves, how they ultimately sell the business, if there's a succession plan within the family, with employees. There are many different variables to consider. And our exercise of going through the financial planning process would be to identify all of those alternatives and then make a determination as to which opportunities make the most sense to pursue and which ones you don't need to worry about. And ultimately, we know that for everybody, they're not going to live forever, and whatever wealth they accumulate in their lifetimes will ultimately pass to others. So we can also look at all of the various options that are on the table that they need to consider as to how that wealth might pass, whether it's in their lifetime, whether it's after they're gone. Does it go to charity? Does it go to children? Does it go to grandchildren, a spouse? There are many options to consider, and our comprehensive planning process would walk them through all of the things they need to know and then give them actionable steps to be able to take to make them better off than they were when they started.
So help me a little bit here. I understand the retirement capital needs, solvency test. You talked a bit about compensation planning, how somebody gets paid. You know, there's been a rule of thumb out there for a long time that to the extent you should take out enough salary from your business in order to generate the maximum RSP room. It's about $125,000 odd a year. And if you have a lot of money that you're building up inside your corporation, you bonus down and you pay it out to yourself. And I mean, most people know this. Most people's accountants have been doing this for a long time. Why would anybody do anything differently?
Well, the first thing I'll say is, in a lot of cases, accountants rely on traditional rules of thumb. Accountants aren't always known as being the most progressive people when it comes to these things.
You're awfully progressive.
Well, I'd say that comes probably more from the financial planning side of my background than the tax accounting side.
I'm a financial planner.
But the tried and true rules of thumb don't stay tried and true forever.
Okay.
There are changes in tax rates, and the issues that you're speaking about bonusing down and taking salary, this gets us into a theory called integration.
Okay.
And for tax purposes, what integration means is that in theory, if a business owner runs a business and draws out a salary, they would pay a certain tax rate on the salary. The current top marginal rate, other than the Ontario surtax, is 46.4% right now. So integration, the theory tells us that the alternative would be for the business to pay tax at the corporate level, and the owner to then take dividends out of the corporation and pay tax on the dividends that they extract from the company. So the combined tax rate of the corporation paying the initial corporate tax, plus the dividend taxes that are paid on the shareholder withdrawing the funds, should be the same as the shareholder simply drawing out a salary. The reality is the federal rates have changed, the provincial rates have changed, and the theory of integration is no longer holds true. It's no longer perfect. So there is a preference in different years. It might be salary, it might be dividends. Currently in Ontario, there would be a preference, generally speaking, to draw dividends rather than salary to minimize the annual tax hit. This would be true particularly where the corporation is earning active business income up to a $500,000 mark. That's where the small business deduction ceases. Where a corporation qualifies to use the small business deduction, it allows the corporation to pay tax at 15.5% on active business income. If the income exceeds $500,000 per year, the corporate tax rate goes up to 26.5%. It means the idea of taking dividends over salary, well, the reverse becomes true above that $500,000 mark. In general, many of our small business owning clients would have corporate income up to that $500,000 mark. And where they fall into that category, if we crunch the numbers, we find that dividends can be more efficient. There's further complications that come up because you're no longer generating RSP space when you're not drawing earned income, salary, out of the corporation. So you have to look at where the surplus would be accumulated. And if you're not drawing salary out from the corporation, you're not contributing to CPP. That could be a good thing, could be a bad thing. There are pros and cons, all of which need to be fully fleshed out when we're working with business owners to make a determination. Does it make sense to continue with salary, or does it make sense to continue with dividends? Year by year, that could look different, but today, dividends could provide a better result, and the implications of that would be, rather than saving money inside an RSP, a business owner would save money inside their corporate structure. Generally, we don't like corporations accumulating surplus inside their operating businesses, their opcos. So that leads us into the idea of setting up an investment holdco where the surplus funds that fall out of the operating business that aren't needed to run the operations can be moved into a holding company and retained for later use by the shareholder or shareholders.
And so then beyond this decision as to compensation, whether you take your income as salary or take it as dividends, I understand business owners are in a unique situation for a couple of reasons. They get lots of great write-offs, which is a great reason to be a business owner, and they can split income. They can pay half their salary to their spouse and take the other half themselves, pay less tax, and everybody's happy.
Well, the one thing we have to bear in mind if we're drawing salary out of a corporation for family members related to the shareholder is that we have to be conscious of what's reasonable to pay them under the circumstances. The rules have been set up where you can't simply pay any number you want, any salary amount you want. It has to be reasonable for the work that's performed. And CRA, Canada Revenue Agency, is particularly vigilant in looking at these situations where there are family members involved. Because the way our system works today, it would be a lot better for two spouses to each earn $50,000 and pay tax on that, compared to one spouse earning $100,000 of salary and the other earning zero. So because the government is aware that there is an advantage to splitting income, within family groups particularly, they've set up a number of rules that prevent it from happening very easily. So from a tax planning standpoint, we want to look at opportunities that may allow us to take advantage of income splitting, but don't fall offside the rules that are in place. Using dividends rather than salary is one alternative that gets us around the issue of reasonability. Dividends are paid to shareholders based on the profitability of the company, not based on the efforts of the shareholders.
Okay.
So salaries can still be paid to family members. As long as they're reasonable, there shouldn't be an issue. But dividends can be paid without respect to the underlying duties performed. So that may give us a better opportunity to split income within family groups compared to simply paying out salary.
And I gather in some cases it's not just as easy as saying I'm going to pay you this dividend, you that dividend. There's legalities behind it and ownership and ways in which you might have to restructure the company in order to accomplish that?
Absolutely. In order to receive a dividend, you have to be a shareholder of the company. You can be a direct shareholder, meaning you own the shares yourself. You may be an indirect shareholder, and this is a fairly common structure. Indirect share ownership would happen through a family trust.
Okay.
So if a family trust was put in place, the trust itself could legally own the shares, and the family members could be beneficiaries of that trust. So dividends, from a technical standpoint, would be paid from the corporation to the trust, being the shareholder, and then be distributed from the trust to the beneficiaries at the discretion of the trustee or trustees, thereby achieving income splitting and presumably tax savings without necessarily having direct ownership.
So it sounds to me like this goes far beyond simply how much is enough, how much do I save, how much do I put in my RSP. Beyond that, it's how do I take out my compensation? Do I have an RSP? Do I contribute to CPP? who do I pay money out to, who owns my business. Sounds like there's an awful lot more beyond what you might be looking at right now. We're going to take a break here. We're talking with Paul McVeen of Objective Financial Partners. This is the Objective Financial Hour. We'll be back. Hi everybody, welcome back. This is the Objective Financial Hour. I'm your host, Jason Heath. I'm here with Paul McVeen, an accountant and a financial planner, but not an investment advisor, not an insurance agent. Paul doesn't sell investments. Paul doesn't sell insurance. He works with people that do, and I think that is a very interesting service offering that you have. We talked a little bit in the last segment about the fact that accountants may be very good at what they do, investment advisors very good at what they do. Sometimes there's not quite the synergy of information sharing, likewise with estate lawyers and whatnot. You're in a unique position to bring that all together, not only for business owners, but for the investment advisors of business owners who you've worked with over the years. Can you talk a little bit more about that?
Sure. I think given my background being both an accountant as well as a financial planner, I'm able to take those two worlds and bring them together in a lot of ways, and I understand how both sides need to function. So I think I'm in a unique place to be able to assist financial advisors and to work with clients' accountants as well to be able to ensure that the advice that's provided is consistent and ultimately will be in their best interests. As I mentioned previously, I've had a lot of experience working with financial advisors to bring particular financial and tax planning expertise to the table for their clients. One of the things I'm excited to be doing now is to be able to work with financial advisors to provide financial planning expertise, tax planning expertise, and estate planning expertise to their clients. So financial advisors may decide to engage us for their clients, or may actually refer their clients to us to be able to provide that expertise. We can take some of the burden off financial advisors in terms of what they need to know and how much time they need to spend working with those clients. But financial advisors can be reassured that their clients are receiving the kind of planning that they really need to be getting in this day and age.
So just to reiterate then, you have worked in the industry as in a head office role providing support to investment advisors for their clients who are business owners. You were tied to a specific product that the client had to invest in and had to have a certain amount of money to invest in for the advisor to benefit from your advice. You're now in a position where you can work with any advisor, you're product agnostic.
Absolutely.
And you can simply provide expertise to investment advisors on behalf of their clients and to their clients?
Absolutely. Advisors may choose to use us in different ways. They may choose to use us behind the scenes to be able to do work that the advisors themselves can deliver to their clients. They may choose to actually bring us in, whether it's in the prospecting stage to help bring new clients on board by explaining what can be offered on the financial planning side. It may be in working with the clients alongside the advisors in meetings, or they may actually ultimately refer the planning relationship to us, where it would be our job to ensure that the investment component, the insurance component, the financial planning components all work together in harmony for the best interest of the client.
Okay, so first and foremost, you mentioned the potential of providing your expertise behind the scenes. What's that mean?
Well, that can take a few different forms as well. We would be in the position to create deliverables for advisors to then use with their clients. As I mentioned before, we can do very basic number crunching exercises right through very comprehensive financial planning reports where we would look at all aspects of a client's financial life.
So a deliverable might be an analysis of how they should be taking their compensation, salary or dividends. It might be a very simple retirement plan. How much money do they need? It may be very comprehensive. How should they restructure their business in order to pay less tax as a family?
Absolutely. I think we are in the position to be very flexible in what we deliver and how we deliver it. So we can look at different components of a full financial plan on a piecemeal basis, if that makes the most sense for a client. Sometimes clients will come forward with specific questions, such as, I'm thinking about selling my business to my employees next year. What should I know? We could get into an issue like that in a comprehensive fashion and dig into the details and come up with our recommendations and our potential solutions for them. Or they might just simply be looking for a broad view of their own financial situation, where we would look at that as just one of many aspects. So we can deliver piecemeal and we can deliver comprehensive. It just depends on what's most suitable for clients. The investment advisors themselves may have an idea of what they would like for their clients, but they might also look to us to help them determine what would be most appropriate in terms of delivery. In some cases, we need to act very quickly if there are impending potential transactions in the works, whether it's a business sale or retirement or something has happened in the business that causes us to need to act quickly. We can look at pieces in isolation, but we can also take time and build a more comprehensive plan to be able to deliver that would speak to a whole host of issues.
So I understand the different range of things that you're in a position to be able to offer, and that's great. But say I'm an investment advisor, I've got a client. The client is paying the investment advisor in one of many ways, but basically they're getting paid on the investments that are being managed. You're running a business. How do you fit in here? How do you get paid? Who do you work for? Do you work for the investment company? Are you hired by the client? What are the dynamics?
Again, we can be very flexible in our approach to how we become engaged. We have some financial advisors who are engaging us directly, where they are hiring our firm to simply provide the output that they're looking for. They pay us out of their own pocket.
So it's just it's an outsourcing relationship essentially, like outsourcing your IT to a professional, you're outsourcing your corporate planning.
Absolutely, and that service can be provided to them on a white label basis, meaning we essentially are behind the scenes and clients don't necessarily see our firm's logo, or they can have us step in and provide that as a third-party provider. So really it will depend on what the investment advisors are looking for with how we appear to the clients. We can look like we're on their team, or we can look like we are outside third parties as they see fit.
And so let's say the math doesn't quite work out as far as the investment advisor hiring in your services. Financially, it just doesn't suit their model. The economics don't justify it. How can you still work with an investment advisor and their client?
Well, we have other cases where financial advisors are essentially referring their clients to us to provide the planning. So the clients make a decision to engage us and pay our fee, typically an annual retainer fee that is very affordable in the industry, where we can deliver our expertise. That way the financial advisor is not involved in the revenue model at all. They still are paid the way they traditionally would be, whether it's being paid on assets, whether they're charging fees to their client directly. However they decide to work things at their end would be independent, and clients could choose to pay us directly for that service. We would still work in harmony with the investment advisors under that model. So there'd be really no difference in the level of service being provided. It's just we can structure it in any number of ways to suit each situation. Some advisors would look to engage us particularly for their larger clients, where they are receiving more revenue directly and not have the client impacted at all. Some advisors would choose to have clients pay us for the services that we provide. And in some cases, advisors may look to adjust their fee level to compensate the clients to account for the fees that we're charging. But as I mentioned before, fees are I would say very reasonable for the services that are being provided, and really ultimately, no matter who is being charged or who's being billed, our job is to deliver excellent value for the dollars that are being paid, and that's what we're here to do.
And what are those fees based on ultimately? Something to do with the assets? How does the math work?
Well, it's really based on the complexity of the situation. So it's not based on assets. It doesn't matter how much money clients have invested. It matters what we are delivering to the client. And if their situation is relatively straightforward, fees would be a little bit lower because it requires less time and expertise on our side to give them what they need. And if the situations are a little bit more complicated and more time-consuming, fees would be a little bit higher. But case by case, we can work with advisors and clients to determine what actually is the best solution for them to consider with us.
Okay, so whether it's an advisor or a business owner, whoever's hiring your services, whoever's paying for your services, it's essentially based on time. Now, does that mean you're tracking 6-minute increments and invoicing as work is done, or how?
I'm happy to say I've left those days long behind me. I think that from a client standpoint, they can be reluctant to call their professionals when they know the clock turns on.
Okay.
And really, we would much rather be in a position to deliver our value, deliver our expertise to clients without anybody worrying about a clock. So generally, we are charging a yearly retainer fee that allows us simply to be involved. In some years, we might spend a tremendous amount of time. Other years, it might not be as much. But generally speaking, we want clients to know that they can call upon us as required without having to be worried about an extra invoice showing up. There'd be virtually all of the work that we'd be doing on the planning side would fall into this model. If advisors would like to bring us in to work on a specific case and not necessarily engage us for the long term, we can quote based on particular jobs, but we really would prefer to stay away from hourly billing if at all possible.
And so then from your perspective, who is the right client for you? If an investment advisor is looking to hire your services or refer an individual to you, what are the parameters?
Well, it's really just based on looking to deliver financial planning expertise. The size of the client really doesn't matter to us because we're not charging our fees based on the size of the client's asset base. We're really looking to be involved. As I mentioned before, we can deliver very straightforward, simple financial planning deliverables. We can deliver very comprehensive financial planning deliverables or anything in between. So from a client standpoint, there really isn't anybody that wouldn't be a good fit for us to work with. It just depends on what the advisors would like to be delivering themselves versus what it would make sense for them to outsource to us.
And then beyond that, what type of advisor should be hiring your services or referring somebody to you? I assume it would be somebody who doesn't have very much knowledge themselves, and that's why they'd refer out to you?
Not necessarily. That may be one of the reasons why they would look to us. But besides expertise and experience, advisors can look at us as simply being able to provide additional capacity. We think advisors' time is most valuably spent working with their clients and bringing new clients on board, really looking after the relationship side of things. So if we can take some of the planning work off of their plate where they're still in a position to deliver it to their clients, but not have to spend all of their own time doing it, we think advisors can then run more efficient practices, delivering a higher level of service to their clients as well.
So you're not necessarily saying that you can provide more knowledge and more expertise than an investment advisor, just that that's all you do and you can be there to provide that support?
Absolutely.
Okay. Well, very interesting. I have to say, don't see a lot of this in the industry. Like I said, it tends to be internal tax, insurance, and estate planning experts that work with clients with very large amounts of money at different financial institutions. The expertise that you're in a position to provide tends to be tied to a product kind of interesting for investment advisors or business owners for that matter to be able to get it without a product attachment. Paul McVeen, I thank you very much for your time today.
Thank you.
Everybody, we're going to wind up now. This is the Objective Financial Hour. I'm Jason Heath. Thanks for joining us.